Welcome to this episode of Market Conversation. In this episode, we clip excerpts from the quarterly market outlook call held on October 8th. We hope you enjoy it. With any questions, feel free to reach out to us. Thank you. All right. This is Satya Pradhuman, and welcome to this Cirrus Research Conference call. Before I go into it today, I want to let you know that Nick Pilar is joining us. He's an analyst on the strategy team here at Cirrus. He'll be walking through a very specific topic on industrial investing. Before I jump into it, though, I got to say this morning commuting in on the train, something very pleasant happened. It was like before 6 a.m. The train pulls up, the conductor jumps out, and he's kind of very cheery fella, and he says to the folks standing there waiting to get on this train, half asleep. So he's like, "Hey, fellas, what happened on this day 68 years ago?" And I'm still trying to wake up at the time, but he then finally looked at us, and we looked kind of completely out of it. He's like, "Well, Don Larson pitched a perfect game in the World Series." And in an instant, it sort of not only woke me up, but it kind of put a smile on my face. So with that, welcome to the fourth quarter, the outlook from Cirrus. It is baseball season. If you're in New York, it is a big deal. I find that being the Yankee fan I am, yes, I am rooting for the Mets because we really, really want a Subway Series where the Yankees crush the Mets. And with that, let's jump into it. All right. The title of the outlook, Credit Expansion Cycle to Broaden Leadership and Temper a Quality Bias. There's a bunch of things we're going to cover today. At the top of it is, lots of talk about leadership, the break in leadership. Is there a market broadening? Ultimately, it's been very much a AI-driven, theme-based investment market. Active managers in the large cap camp have had a very, very tough go of it. Smaller cap, mid cap active results have been actually pretty decent, and we'll go through what's causing the difference and will that change in the larger cap arena. In addition to this sort of discussion on leadership, we'll talk a bit about the interest rate cycle, credit, and how that sort of links back to the outlook for markets. That one of the more popular takeaways from this recent Fed action has become, let's become more defensive. The Fed is cutting rates. We expect a slowdown. After all, the Fed is always late, and so on. But looking at the data more carefully, the risk, what we see, may end up being more of a bearish steepener. So we'll talk a little bit about the bearish steepener, what that is, and also what the implications are. Ultimately, we'll talk a bit about active versus passive strategies, the difference results in large, small, and we'll talk about a few sectors and themes. Clearly, we'll focus on the industrial supercycle that we've been talking about for the last few years. And with that, let's jump into it. In looking at the overall profit cycle, we've made a big deal of this. It's actually created a more constructive outlook for equities. That is a place in which companies' profit cycle, the comparisons are bottoming and they're beginning to improve. In fact, in a lot of our work, we could see how this actually carries through across countries, across regions. And importantly, when we look at the US as it's really begun to stabilize and recover, we're also looking at where the forward estimates are going. And broadly speaking, the forecasts for the forward year earnings have been on the mend. In fact, over the last 12 months, we've really moved away from that Fed tightening cycle. Companies have been able to stabilize their growth rates, and the forward estimates are now climbing higher. Clearly, there is an exception there, which is China. So what we do see is the earnings estimates, the forward estimates for China remain incredibly soft, given the recent events with liquidity being added in China. To some degree, will that turn around? So what we've seen is that the Chinese equity markets have bounced, but can we see the fundamentals carried through? To be seen. But to bring this back to the States and the current equity portfolio in the US, This idea about running a quality growth fund, a small cap fund, et cetera. The elements here are really set for a very constructive equity outlook. In addition to the bottoming of the profit cycle, what we also have is a credit backdrop that's quite favorable. This, I think, is terribly important for subsequent periods of earnings growth. When we look at the US, for instance, we're looking at structurally low interest credit spread relationships. This really has been, if you go back 20, 30 years, we're now at levels in the 250, 300 areas in terms of spreads between high yield and treasuries that are just remarkably conducive for business. Importantly, when I look overseas, we're seeing something very similar, that spreads have come in. In fact, if we look a little closer at this in the more recent few years, what's remarkable to me is in the last 3, 6, 9 months, we've also seen a convergence in credit spreads where the US has been fairly steady, pretty favorable. But what we're now seeing is a structurally lower level in credit spreads across regions, whether it be Asia, Europe, or Latin America. So when it comes to the sort of risk assets, the stocks versus bonds outlook, a lot of these things portray a very pro-risk posture. If we look a little deeper into the credit cycle and specifically into sectors and industries, when we look at the US financial sector, when we look at loan growth activity, it has finally begun to stabilize in the last year or two. And in fact, maybe more interestingly to me, the earnings estimates for larger banks and smaller banks have bottomed and have begun to recover. When we look at the percentage of estimates, percentage of banks with forward estimates on the rise, they're nearing a 70% handle. What that means is roughly 7 out of 10 estimate changes for the forward year are being increased. That's a big deal. It's very consistent what we're seeing in the fixed income market as well on credit, as I've just gone through. Importantly, this translates as well to corporate activity. So what we are seeing is an increase in M&A transactions, not a drastic increase, but we've definitely seen this sharp increase in high yield issuance. You bring this all together, and what that's saying is the capital markets are beginning to ease. And so this sort of like really brings to surface now the good stuff and potentially the concern we may have, which is as the Fed is easing and the capital markets are easing, what can go wrong, right? I mean, it's this sort of like combination of where earnings growth shouldn't be incredibly strong. And at the same time, this year, we've actually seen pretty favorable inflation comparisons. The risk I fear, though, is that to some degree, you've got a 10-year that's just in the past few days that's begun to trade over 4%. I personally thought, a 3 handle on the 10-year seemed a little way too low when you consider where the jobs data is, how the inflation data has improved, and the fact that the central banks globally have been easing. In terms of the sort of market outlook, we continue to make a case that the fact that the Fed is cutting rates does not necessarily mean that we have to go into a recession. If anything, as I've said, the risk is potentially the opposite. This idea of a bearish steepener is more likely with every moment that the Fed continues to cut rates. So what is a bearish steepener? Effectively, it's as they cut the short-term rates, the outlook for growth picks up, and that causes the 10-year to sell off. As that occurs, it does create some favorable backdrop for certain groups. Financials, for instance, some of those groups, banks could do quite well. Part of it is the loan growth activity could actually end up being much more profitable. Businesses clearly have an easier backdrop. But the dark side of this is that from an equity portfolio standpoint, if the 10-year continues to back up, that is a lower multiple market. In other words, this idea about a rotation, a broadening, these things are all telling us one thing, which is there is potential here for a rotation from a very strong growth cycle that's beginning to move more into a value rotation. And so what this means is that on the margin, if we're looking for companies, valuations are going to matter more. If if earnings growth are more robust, then by definition, the question isn't where do I find growth, but what's the right price for every unit of growth I buy. And so when we look at some of our own indicator work, the Cirrus style oscillator, that's a reading that's now squarely in a value camp. It's been in an overweight value reading the last 3-4 months. It's remaining in this value arena, currently in a lean value mode. I've got to say, though, the last time this model went towards a value overweight was probably 20 years ago or more. And so this is a big deal. It is telling us that there is this potential rotation in leadership that is underway. And we've already begun to see some signs of it. When we look at, for instance, over the last year and year-to-date numbers, what we'll see is in the smaller cap market, deep cyclicals have actually done well. Industrials are up 16% year-to-date. Materials are up 8%. Energy lagging at 2.5%. I have a feeling that's going to look very different at the end of this month. The benchmark, though, for small caps have lagged. Technology, though, is down 0.7 in the smaller cap area. Take a look across into the larger cap pool. What we're seeing is a technology sector that's been very dominant, up 27, 28% or so. Clearly, NVIDIA, those numbers are even more stellar. But what's important to recognize is the deep cyclicals, even within the large cap benchmark, on an absolute basis, their numbers are in the 17% up for the year for industrials. Materials are up 14%. Energy is up 9%. Moral of the story is this market has been broadening. And also, I think for good reason. We looked at the last quarter. What you saw was small caps have begun to outperform, not in a massive fashion, but a 3 percentage point spread in the prior quarter that we have noticed. In addition to that, value has outperformed in the larger cap arena over 500 basis points in the third quarter. That's pretty significant. The smaller cap spreads between value and growth more lead, but clearly a big difference in the larger cap arena. This idea about a broadening, when we look more fully across sectors, more sectors are participating in returns. Now, when we can look at the number of sectors in large cap, what we're seeing is that the benchmark was really at the bottom end in terms of performance. You had over 2/3 of the sectors outperforming the group, the benchmark. In fact, the technology sector lagged the large cap index in the third quarter. Smaller cap arena, very similar picture. So this idea that there are more stocks participating is good news. And it's also, I think it's based on the fundamentals, this idea that if profits are expanding, more companies are more likely participating in that. If we take this argument a little further, this idea about a broadening, this idea about valuations mattering, what it does mean is active strategies will be stronger. Just because the ability for a fund manager to pick a name with good fundamentals that's going to climb higher, that's more likely in a world where the profit cycle is expanding. When we look at explicit growth comparisons in our active strategies, and here we're going to use a central tendency model, the GARP model, what we're finding is the small cap GARP models outperformed this year by 400 or 500 basis points against the small cap growth benchmark. In the larger cap camp, as you know, to no surprise, real struggle there. In fact, last year, 25% lagging in terms of how the larger cap models fared, large growth fared against the large cap growth benchmark for obvious reasons with AI and NVIDIA. This year, however, that number is much more muted, where our large growth model is now flattish year to date relative to the large growth bogey. So very different market. On the On this value side, a slightly different picture. Active blends, both here we're using a relative value blend against the value bogeys. In small caps have done quite well this past year, roughly about a 500 basis point advantage. And interestingly, a similar sort of spread as well with the large value blends. And so something that I think is good news really for the active management business. The unfortunate fact, though, is that this has not been the reality in 23 and a good chunk of 24 in large growth. That competitive box has really, really been challenged. So to tie this together, when we look at the growth market in terms of growth strategies that we here at Cirrus run, given the backdrop I've painted with an earnings cycle that's on the mend, a credit market that's quite easy and likely to get easier, these things are telling us that our GARP model, that's the model that's got a focus on forward growth combined with valuation. Those elements in this marketplace really matters. In addition to that, what we're not emphasizing as much is pure trends. The aggressive growth model has done incredibly well in this past year and a half. That, though, is an issue here. If we're right, what we've effectively painted is a barbell picture, this idea that it's quite possible to see this sort of leadership with AI maybe continue, and at the same time, to some degree, begin to give controls over to more of a cyclical, deep cyclical sort of portfolio. So the GARP model, I think, holds. Additionally, as I've covered, this idea of the risk not being to become defensive, that there's a slowing, but the risk could be that there's maybe a faster growth on track, which potentially is a bearish steepener. If that's really the case, then do we really need to pay up for high quality, very visible earnings, or do we want to take on some incremental business risk? So if we're right about the credit story and the sort of earnings trajectory, paying for the insurance of higher quality is probably unwarranted at this point. Similarly, in the value blends, we run 3 different value blends: a deep value model, a relative value model, and a quality value model. For everything I've just said, it's a good reason that we're not going to emphasize the quality value model. Instead, we are squarely in a relative value world here on the value front. Why aren't we in the deep value camp, given everything I've said? Well, the deep value model, I feel, tend to work best when you've gone from a crash and burn economy. In other words, if this was an environment where it was incredibly slow, that the Fed had failed, it tightened so much that we went right into a deep recession. At the bottom of that is a place where we might want to consider deep value strategies. The idea is that credit spreads are awfully wide, the earnings comparisons are terrible, and we begin to see some mending. And as that occurs, deep value strategies should work best. But that's not the backdrop we're in. We're in a very different period where you have an expanding profit cycle, but not a drastic 0 to something sort of cycle. To sort of tackle this subject, though, of leadership, when we look at the NVIDIA numbers, they're remarkable. You've got a nearly $3 trillion company that's growing incredibly fast. The most recent run rate that we're looking at for sales growth, it crossed over 200% in the prior couple of quarters. That's remarkable. And so the question here is, this recent amount of volatility in NVIDIA and the markets is striking. And what we'll notice, though, is that if you look at the sales growth data more closely, what we're seeing is a decelerating top line number. And it makes a ton of sense. We use the word law of market gravity. The idea is that, can a nearly $3 trillion company grow its top line beyond 200% in a steady fashion? In about 3 years, that's going to be greater than the US GDP. So we know there's a bit of gravity at work here. There's some limits that this firm will hit. But that said, is it today? Do the comps begin to roll over sharply. And in this report, the comments, a lot of the comments from this call comes out from the quarterly dispatch. And in that, we included some new material. At the end of the day, we believe one of the sort of telltale signs for this leadership run is really the fate of NVIDIA lies in its hands of its customers. When we look at its key customers, whether it be Oracle, Apple, Google, etc., what are their margins like? And at some point, their investments will begin to hurt their margins. When we took a closer look, if you were to take larger tech margins, you'll notice that they're at the upper end of where they are, nearly north of 30%. And then when we take that special mega tech sample, what we'll find is that those numbers are north of 35, 36, 37. That's remarkable. Importantly, though, the trend is rising. And so to some degree, this becomes a key indicator to us to ultimately say, if AI spending is going to slow, it's going to be because its customers can't afford to spend as much. How can we tell where they're going to hit that wall? When their margins begin to suffer. We saw a hint of that with Microsoft's last quarter's earnings report. So I do think this is a really critical way to look at it. But for now, what this is saying is that the spending backdrop is likely to be solid because its customers are healthy and they are in soaring demand for AI chips. We talked a bit as well about leadership and in the past quarter on how it's becoming more diverse. And we've suggested that in theme-based markets, once we establish one theme, investors begin to look to other themes. And this idea about GLP-1s, the Eli Lillys of the world, that's also become it's run in a pretty spectacular fashion. In fact, when you put the sort of Lilly chart against, for instance, the Mag 7, it's actually been outperforming and accelerating in the last year. And so this idea of leadership, as much as the temptation is to say we've got to see a break in leadership, to be quite frank, it's really, we're not quite there as yet. Some additional work that comes out of our signals report that I think is important is that tactically, the readings such as our polarization measures, I know it's very popular right now to quote that if you were to sum up these 4 or 5 stocks in the marketplace, they account for 80, 90% of gains, or some like inordinate number. And I think we've got to be a little bit cautious there. The sort of simplistic measure of crowding is, hey, how many stocks are beating the market, or how many stocks really accounted for the market gains? Another way to think about it, though, is what are those leadership stocks? How are they performing? But also, are their earnings growing into their market caps? And when we look at our polarization measure, we actually bring into it an earnings component. And when we look at our crowding measure, the CPQ, as we call it for short, the Cirrus polarization quotient, those numbers are now still benign. Back in March, April, they did spike. They flashed red, suggesting that the market was really stupid crowded. We had a sell-off in April, and that's since adjusted. Very important extra data point, though, is what we also notice is that in today's leadership basket, it's much more even-keeled. In other words, if you go back a few years ago, in the thick of this sort of at-home portfolios, that sort of leadership with Zoom and those types of firms, in that period, over 60% of the portfolio was dedicated to tech and healthcare. Today, very, very different. We have sizable exposures to financials, industrials, and a number of other groups. So yes, technology is still sizable in the leadership basket, but it's a lot more flatter. And that's a good thing, because if there is a shakeout with NVIDIA, yes, that will hit the whole market. That adage of, as NVIDIA goes, so goes the market. I buy it. I think that's a very real risk in the system. But to some degree, the fact that our leadership portfolios, or baskets, I should say, they're much more flat and even keeled is incredibly supported. It basically spells of a market that's a bit more resilient. And then a couple of other notes here on this idea about becoming more defensive. It is a very sort of knee-jerk move to say that, hey, if the Fed's cutting rates, they're probably late and the system's probably a lot weaker than we think, we should get defensive. If you take a closer look at quality, low quality specifically, what we find is that low quality firms, the growth rates for those firms had been slowing sharply the prior couple of years, especially in coincident with the way the Fed was tightening. That said, guess what? We've got low quality firms where sales growth is now stabilizing and on the mend. Couple that with the fact that we're seeing easier and easier credit. Couple that with that it's a global phenomena, and we're seeing record high yield issuance. What that says is that lower quality firms are likely to grow faster with an easier credit backdrop. So this sort of framing of the portfolio, yes, we do have the sense that there's more of a barbell. It's not a black and white story. I wish I could tell that, hey, it's a value run, this NVIDIA trade is over. No, as best as we can, some of the fundamentals on spending are still in place. The interest rate backdrop are generally constructive. CapEx tech is also accelerating. So it is something that we have to respect with this leadership profile. With that, what I want to do now is introduce you to Nick Pilar. We've done a lot of work. He's a senior analyst on the research team here at Cirrus. Done a lot of work in the last few years on industrial spending and the industrial super cycle, as we've called it. And we made a case for this in the past few years, really coming out of COVID, this idea that there is a rebuilding that was going to be underway, this idea about the geopolitical risk driving really reshoring across the world. Those are all elements that spell industrial buildup. The fact that the Ukraine attacks come underway, the fact that ultimately forces Europe to really re-engineer its energy plans. All of these things come together. As we speak, we have yet another storm barreling into the coast. What's the repair? What's the retrofitting that's got to get done at the end of all of this damage? So we think we're in an era of fairly strong industrial spending. And with that, let me bring in Nick Pilar. Nick?
All right. Thank you for the introduction, Satya. So what you see in front of you is a chart that we've been tracking for quite some time, which takes a look at tech spending versus industrial spending as a percentage of GDP. You can see the purple line, the technology spending. That's actually at an all-time high from when we've been tracking this back to 1970. And in fact, the prior peak was during Q2 of the pandemic in 2020, which was also a low for industrial spending. Just a few things to note about this chart to give it some more context. If you go all the way back to the 80s, during the Volcker shock, which was a very steep, sharp recession at the start of the 80s, coming out of that, industrial spending was close to 8% of GDP, whereas technology spending was well below 2%. So I bring that up just to note that, and you can see this as in the chart, it should be apparent that industrial spending has not reached the levels that we typically see during industrial recoveries. That typically goes above 5%, and we're still sitting at around 4.5%. It's been gradually ticking up since the low in the second quarter of 2020. And on the flip side, technology spending has secularly grown as a percentage of GDP and is currently at an all-time high, with this going through Q2 2024. And then on the next slide, what you can see are some performance numbers, which tracks the relative performance of smaller firms and larger firms versus the industrials and technology sectors. We focused in on the early 2000s period just because that value cycle, following the collapse of technology spending during the tech cycle, was actually the longest value cycle that we identified in our case studies. This was something that lasted for several years following the peak of the tech bubble. In this, on the left-hand side, you can see the relative performance in more recent times. And similar to what Satya was describing before in the performance of the momentum baskets and active models, there's a pretty big divergence between small caps and larger firms. But you can see larger firm technology is still outperforming. The relative performance for smaller technology is not as impressive. Similarly, smaller industrial firms have consistently outperformed, whereas larger industrial firms have they've seen some outperformance, as Satya referenced. There's also a number of industrial firms that are now in market leadership, as you might measure it, but the road has been a little bit rockier. And then finally, in our final slide on this section, it's a look at infrastructure. So again, this is a theme that we've been tracking very closely, particularly after the pandemic and the planned spending for that. But also, it was something that we were interested in before the pandemic due to the various infrastructure needs, both technological and otherwise necessary for the U.S. economy. So far this year, the infrastructure basket has continued to accelerate relative to the broader market, a little bit more muted than the past few years, but in large, mid, and small, we've seen that a focus on infrastructure has continued to outperform, which also corresponds to this large outperformance. This large percentage of spending for both technology and industrial spending, which is above average levels, and in both cases is continuing to rise. Thank you, Satya.
Great. Thanks, Nick. So yeah, at the heart of it, we've got this positioning on infrastructure industrials, and a lot of it has to do with this current environment, the post-COVID event, this sort of geopolitical crisis that we continue to see. All of those things sort of stretch into a reinvesting, and to some degree, when we consider climate, when we consider really alternative energies, all of these things are really about CapEx. And so in this sort of pro-cyclical backdrop with easier credit, we think this is a big deal. To me, it's shocking that you've seen industrial stocks outperform in the prior 2 years in a global central bank tightening cycle. I think that's incredible. And so what happens if the central banks begin to reverse course? So to be seen, but we like what we see. To really pull this all together, we continue to remain valuation sensitive. This idea that a GARP framework in this environment should work quite well for growth managers. The opportunity here is that earnings growth, company earnings growth should be quite strong. So factors that we'll pay attention to are like earnings revisions, business momentum broadly should be a good thing. In addition to that, we want to be more penny pinching. We want to look at every unit of growth we're buying now because more companies are growing. We have more opportunities to get better value. So I think that's really how we're going to position this. The big takeaways from the call, really, what inning is this break in leadership? We think it is late in the game, just given some of the comparisons we've walked through. That said, ultimately, the sort of trigger will probably be driven by the customers of NVIDIA, and best as we can see right now is that they're still going to spend quite a bit. That said, just to be really sober about all of this, if we've got NVIDIA's top line growth beginning to decelerate, it's a whole new buyer that's in that stock today than there was 2 years ago. So that things are already quietly changing. This idea about a bearish steepener, we're very counter, I think, to the consensus that we do not want to position on a defensive style. to some degree, I think lower quality firms are likely to do better here, given the backdrop we've painted. The risk in equity returns, though, as much as this is a pro risk on position, the risk is that if you end up getting a bearish steepener, yes, we'll see a broader market. Yes, value will outperform, but it is a lower returns market. After all, really, it's slowing periods where you have a growth cycle that you get a multiple expansion market. So if the 10-year is working against us, it's hard to see excess returns being spectacular. So that's something we're sort of bracing for. And to some degree, also good news in the sense that active strategies are starting to come back. We've seen that very, very powerfully in the smaller cap arena in the last year and a half. We'll see if this begins to spread higher up. And then finally, key themes, this industrial spending story we think is a big deal. Take a look at some of the published research. We've also spoken about credit expansion in terms of financials. They're going to matter a lot more if we're right about this sort of credit cycle and the period we're going into. And with that, I want to thank you guys for joining us today for this call. Thank you very much. Good luck to you as you close this year.